Hey, what's going on, guys? It's your boy Freddy. Welcome back to the channel. I hope everyone is having an amazing month in the market as indexes continue to rise even amid all of the concerns regarding inflation. The market has chosen to shrug off all of the news and climb to new all-time highs. Today I want to go over two Canadian dividend stocks that I believe offer excellent growth for the long-term future. These are two fundamentally solid companies that not only offer the potential for large capital appreciation, they have excellent dividends that will hopefully continue to rise along with the growth of the company and see amazing returns for the years to come. Before we talk about the two companies that I'm watching for this month, let's take a look back at the three Canadian dividend stocks that I was watching in June. In June, we researched CNR, QSR, and Ryocan. Since mentioning CNR, we are down about 1%. I have strong belief in CNR and can say that right now is an excellent time to be dollar cost averaging into the company. With the merger with Kansas City, along with their already steady growth ahead, this will be a great winner for years to come. QSR is looking like a great deal as well. In the last video, I mentioned that at $70, it was quite overvalued for the growth that it was seeing, and I would like to see a dip. Well, we saw an awesome 10% dip that I unfortunately did not have the chance to take advantage of. At this current price, I still see it as a solid deal and am thinking about starting a position in the company. Finally, Ryocan has steadily been growing as the country has begun to reopen and leave the pandemic behind. I have begun to seriously add to the stock as I see it getting back to pre-pandemic levels very soon, and the monthly dividend that it offers is very tempting. Every time I see the notification from Wealthsimple that the dividend has been deposited, I want to buy more and more. Today I'm bringing you guys information on a very solid company that has been around for almost 100 years now. It trades on the TSX under the ticker symbol POW. I'm talking about the Power Corporation of Canada. This company has nothing to do with power or electricity generation. It is a financial services company, and well, I guess it does have something to do with power because money is power. The company has been on a tear as of late. It is on my watch list and I'm watching and waiting for it to dip down so I can scoop up some shares. The share price as of making this video is about $40 and pays a cool 4.45% dividend. The company focuses on financial services. It has holdings in insurance, retirement funds, and various investment platforms. Here's the breakdown or the corporate structure of Power Corporation, and here are the various things that you're getting exposure to by purchasing the stock. You're getting exposure to Great-West Life, which is of course one of the three big Canadian life insurance firms. You're also getting exposure to IGM Financial, which is a major player in the investment and finance space, and you're also getting exposure to Sagard Holdings, which is an asset management firm. So by holding this parent company, you're getting exposure to all of these companies essentially. In their last financial report, they released their net asset value to be about $45 per share. So that means that if you add up all of the assets that they own, it is valued at $45 a share, which is still higher than the current stock price of $40. So this is a good sign that there is still about a 10% upside value to be had. The company is generating just under $3 billion in net earnings. These are not all earnings in Canada, as 45% is earned here locally. More than half of it is generated from other markets, including the US and Mexico. A big chunk of this is insurance companies, which are held overseas. So it is a very well diversified. Not only are you diversified geographically, but even within the financial sector, you're getting a well diversified company with sales and earnings coming from all over the place. This is very important that you are not only focused on Canada, by owning stakes in Europe and even some exposure to China, which they own about 14% of China AMC. This makes it a very nicely diversified company. They're doing asset management, insurance, and financials, as well as investments into fintech. If you don't know, it also owns about 70% of Wealthsimple, and if you're new to my channel, don't forget to grab your free $10 by signing up using my link in the description. I've been on Wealthsimple since I started this channel, and it is an absolutely wonderful platform. There are no fees for trading Canadian companies, and it is such an easy and simple to use platform, hence the name. It is truly wealth generation made simple for the regular everyday investor, and the majority owner of this company is Power Corporation. There was a recent article that came out stating that Wealthsimple by itself is valued at $5 billion. This is a product that I use and I stand by. I'm a big believer in investing in companies whose products and services you have used and tested, and it really brings more conviction into your investing. By them owning a 70% stake in Wealthsimple, I think it is going to be a massive part of their business going forward, and they're going to have so much more growth ahead. If you look into Wealthsimple, you'll notice that it has grown 94% year over year from 2019 to 2020, and this platform is growing rapidly, and it is the go-to platform for millennials and Gen Z investors for their finances and investments. So they're investing in some very innovative fintech and are going to continue to do well. Power Corporation is valued at just under $25 billion, and if we add up the value of all the different parts of the company, I think it's trading at fair value. It went on a huge run, as you can see on the chart here, and after this recent run, I do plan on holding out to see if I can get some downward trend before I invest in the company. But because there is so much diversified exposure along with the 4.5% dividend, I wouldn't mind slowly dollar cost averaging into the company. I do believe that there is still going to be more upside because this is an adapting company and they are adapting to the times, especially with their stake in Wealthsimple, that they're putting themselves in a position for growth with the millennial influx. They're paying about 45 cents a quarter per share and they have about a 51% payout ratio, and the dividend has grown for the last 12 years. $10,000 invested into this stock will pay you about $445 a year in dividends, and of course you can't forget the opportunity for capital appreciation. I think this stock is a must watch and I will be looking for an opportune time to get into the company. The current price to earnings ratio is 11.25, and we can use this metric to determine the value of the current share price. This to me is an attractive PE because if we are looking at their last 5 years, it is right in line with their 5-year average. As I said, this stock has been on an absolute tear, so you can bet that there is a good possibility that a pullback is coming, and when it does come, I will be looking to load the boat. So even at today's values, this stock is still pretty attractive to me, but if you are patient, there are going to be opportunities to come over the coming months, and I'm hoping for a $30 to $35 price range. One thing about the company which could be seen as a red flag is their debt. They do have a significant amount of debt and the ratio has gone higher, likely due to their increased stake with new developments into these fintech companies. It is at 52%, which is not necessarily a giant red flag because they have many more assets than they do liabilities. Nonetheless, it is quite high. But their debt is covered by their operating cash flow, which means that the cash flow that they are receiving through their operations can cover the payments they need to make on their debts, so they have no need to dilute shares or take on more debt to cover their pre-existing debt. Another thing worthy of note is that this company has a healthy payout ratio for their dividend. The dividend has grown for the last decade, and you can bet that they will continue to pay it moving forward. The company has a lot of room to grow for their dividend, especially if a lot of their fintech investments in other companies keep growing the way that they have been. One last thing to note is that they have been buying back shares over the last year. As you can see, $2 million worth of shares were bought back in the last 12 months, and another 500,000 shares were bought back within the last 6 months. So this basically signals that they are individuals inside of the company that are very bullish on the company, which is an excellent sign. The second stock that I want to talk about today is Telus. This is one stock that I've been researching for quite a long time and is one that makes up about 9% of my Wealthsimple dividend portfolio. This company has a market cap of about $35 billion, and it is part of the big three telecommunication companies here in Canada, namely Bell, Rogers, and of course Telus. I'm looking at this company because it has predictable cash flows, a very safe dividend of 4.6%, and this company is up over 30% in the last 5 years. The real allure of this stock for me is the safety factor that it is among the big three. There is a monopoly in the telecom industry here in Canada because it is not every day someone can set up the infrastructure needed for telecom, especially not in such a large and vast country like Canada, and obviously the juicy dividend is another important part of the allure. Not only do they provide telecommunication services in Canada, but they also provide TV services, internet, and security as well. A lot of people don't know, but Telus also owns the T.TO mobile service and the public mobile service, so if they are your provider, you're actually a Telus customer. I believe that this is a safe stock because they have consistent cash flows and revenues. Just look at the previous year, they had consistent sales and earnings throughout the pandemic, so it is safe to say that they can handle any ups and downs in the economy. They have grown from $13.3 billion in sales and earnings in 2017 to $15 billion in 2020. So that is decent growth. And like I said, consistent growth, consistent sales, consistent earnings, and predictable cash flows are 4 things that I'm looking for in a company, and that's the type of company that I can trust putting my money into. Let's look a little deeper into their different revenue streams. They have 2 main revenue streams, wireless and wireline. Their wireline stream consists of revenues associated with your mobile phone, that's your data services, call services, and also equipment sales like the phones you can buy through Telus. An interesting thing to note is that their revenue is actually down about $100 million from the pre-pandemic era, whereas their subscribers are actually up 500,000. The reason for this is because when the pandemic hit, no one was really traveling, and Telus definitely makes some revenue from the roaming charges. So due to customers being stuck at home, they had seen a massive drop in roaming charges. Secondly, with retail stores being closed for most of the pandemic, customers had not been able to get into their stores. At these stores is where many customers are persuaded to get a plan upgrade, and this affects the top line sales for Telus. And if you're not having enough conversations with customers, this will drive down sales. And lastly, most likely, the biggest reason is that a lot of people are working from home and they're relying on Wi-Fi and they're not going over their data coverage. These are all reasons you can see a little bit of a decrease in their revenue. However, this is all temporary in my opinion. I think when things start to open back up, you can actually be very bullish for this industry, especially for the wireless segment, because I think customers are going to be able to want to travel and a lot more roaming charges will start to apply. And secondly, right now everyone was at home and no one was really flexing their brand new phones, and people were not really thinking about getting a new phone, and there was no need to take better pictures along with the travel and all those reasons for which people usually upgrade phones. But remember, subscribers are up. So I definitely think that this is a great tailwind for 2021 and especially for 2022. All of these numbers are going to be heading back up. Now let's take a look at their wireline revenue stream, and that consists of internet, TV, residential, and security. This revenue is up quite a bit, specifically the data service side, which is up 20%, and this is due to the fact that more people are signing up for internet, which is up 8%, and more people signing up for security, which is up 16% from last year. This trend is most likely here to stay with more people working from home, and I think even after things completely open back up, this trend is here to stay. The TV and residential voice side is most likely going to continue to trend downward. A lot of people are going to stop ordering the TV services just because there are so many online streaming services that a lot of customers, especially millennials, are using. This $7 billion that wireline services did in revenue is repeatable pandemic or no pandemic, and is a very safe revenue stream. Here's the overview for 2020, and as an investor, this gives me nothing but good vibes. They grew their revenue by 5.5%, and in 2021, they are projecting 8 to 10% increase. They're estimating their free cash flow, this is, by the way, is how they pay their dividend, to increase from 1.4 billion to 1.5 billion. This is awesome because they could potentially increase their dividend as well through this. They're already paying 4.6%, maybe they increase that to about 4.8%. Either way, that is a solid income stream. Even after all of this, they are reducing their capital expenditure or expenses. This is all amazing news for an investor. Revenues are up, free cash flows are up, and their expenses will be going down. These are all things you want to see from a business. Another thing worthy of note is that Telus had the least percentage of complaints as a telecommunication company here in Canada. This was led by T.TO. This is great news because it leads to customer loyalty and potential growth for the future, and it is 10 times cheaper to maintain an existing customer than it is to sign a new customer. So if you do get Telus, you're investing in a company which is doing very well and customers love it. Let's talk valuation. Right now it's trading at $27, which puts it right at above the pre-pandemic levels, which is quite high in my opinion. I think if you can get this at $21 to $24, it is a much better value with more potential for growth. At $27, I think there's far less share price appreciation that can be had. Definitely there will be some appreciation, but not as much as I would like. Market is really overvalued these days, and I think there will be a correction coming up relatively soon. And when that happens, if Telus drops to the low 20s, I'm definitely grabbing some more shares. One last thing to note is that Telus did issue 11% more shares in 2020, which diluted the shareholder value, and this was done to fund their 5G infrastructure projects. This was needed for the growth of the company, as it is important in the long run, as 5G is the next big push for telecommunication companies. Well, those are the two Canadian dividend companies that I'm watching for this month. Let me know what you guys think in the comments down below, and also let me know what you guys have on your watch lists. I'm always looking for new investments and new opportunities in the market to research, so let me know what you guys are researching down below. And as always, remember to hit that like button, as it really does help the channel to grow, and also consider subscribing for more investing videos like this to come. I'll catch you guys in the next one. Take care.